One time or ongoing fees? In this episode, I'm going to address the question fee-based versus commission-based financial advisors. What's the difference? What's better? So my name's Doug Andrew, and I've been a financial strategist, helping people plan for a comfortable retirement for more than 47 years. And I've noticed, being a part of the financial services industry, that a lot of advisors seem to tout themselves as fiduciaries. Now, what is a fiduciary? It is somebody who puts your best interest ahead of their own, okay? I'm all for that. I've always considered myself, when I was helping people with financial advice, to be a fiduciary. But sometimes I think, golly, there are a lot of financial advisors that claim to be fiduciaries, looking out for their clients' best interest. And I will ask them, so do you have any clients that had money in the market in 2008? Yes. Did they lose money in 2008? Yeah, everybody did. I go, yeah, the average American lost about 40%. $1 million nest egg dwindled in value down to 600,000. But it came back. I go, yeah, it took 4 years to come back. By the way, none of my clients lost in 2008. And by the end of 2012, when most Americans were barely back to break even, many of our clients had doubled their money. $1 million doubled to $2 million, where most Americans were barely back to the million. And they go, what? How? What are you talking about? When I ask them, do you have any clients that experienced that? Yes. I go, okay. So do you think crashes like that are going to happen again? Yeah. So do you want to have happen next time to your clients, or to you personally? Do you want to have happen next time what happened last time to your money or their money? Well, no, but the market always comes back. And I go, no, answer the question. Do you want to have the same experience? Well, no, if I had a choice. So what are you doing differently with your money, or what are you doing differently for your client's money? Well, it's still in the market, but the market always comes back. I go, you're not getting the point here. You can help your clients participate when the market goes up and not lose when the market goes down. And they go, using what? I go, indexing. They go, oh, index mutual funds. I go, no. I'm not talking about index mutual funds. They go, well, what do you mean by indexing? I said, indexing is a strategy. An index mutual fund is a commodity that you can sell your client. I'm not talking about a commodity. I'm talking about a strategy where you make money when the market goes up, but you do not lose a dime when the market goes down due to that market downturn. And they look at me with this glassy look in their eyes, and they go, well, I've never heard about this before. It's because most broker-dealers never teach their advisors about this. But let's go back to this fiduciary concept. If you know your clients are accumulating a lot of money, they're disciplined savers, and you can tell that they're going to be likely in as high or higher tax bracket when they retire, especially based upon what's going on with the government, irresponsible government spending, the printing of money, and you can see the writing on the wall that taxes will likely be higher. Are you looking out for their best interest if you continue to defer to some future perceived unknown advantage? What is it? When you're convinced taxes are going to be higher, is that looking out for their best interest? Boy, they shut up really fast. I go, why would you do that? You really ought to get the money out, the taxes over and done with sooner than later, and reposition it into something tax-free from now on. And oftentimes they go, what's tax-free? Are you talking about a Roth? I'm going, no. Now, I've never owned a Roth. I never will, because my favorite vehicle, called the Laser Fund, allows you to diversify and create the foundation for a tax-free retirement. I would recommend that 40 to 60% of your client's retirement income not even show up on the front page of their 1040 tax return. You mean this is a tax loophole? No. The IRS knows they're receiving it, but they know it's totally tax-free. It's been a sacred tax-free cash cow in the Internal Revenue Code for over a century. Now I usually have their interest. Let's go back to this question about, so fee-based versus commission-based. Most of these advisors who are touting themselves as fiduciaries say you should always choose a fee-based financial advisor, a fiduciary, because they do not have any incentive to sell you a particular product. So we are fee-based and we're far better, and it's less expensive. So let me show you what an average fee-based financial advisor does, not only sometimes not looking out for your best interest as far as market volatility or taxes over the long haul, but especially as far as how expensive a fee-based planner can be. Are you ready? So if this is already intriguing you, I would recommend you share this with somebody who maybe you know that is working with a fee-based financial advisor, and they have their money in the market and they're deferring and they're doing really well, and you can sort of tell they're not going to be in a lower tax bracket when they retire. So subscribe to this channel, share, and stay with me to the end, and I'm going to gift you a copy of my most recent best-selling book, and you can also share the link with one of your friends. I post an in-depth answer to a financial question almost on a daily basis on this channel. So let's go through and talk about fee-based versus commission-based. See, a fee-based advisor acts like, well, I only charge you 1% or 1.5% or 2%. Let's just use the low end, 1%. Let's say that you, at a particular point in time, engage with a fee-based financial planner, and the advisor goes out, we charge you 1% a year on whatever your assets are worth at that point in time. This is very common. So let's say you start out with $500,000, and so they're going to charge you 1% or $5,000 that year to manage your $500,000. Now, let's say they're doing a really good job. For years, when I had my clients' money back in the market, back in 1974, 1980, and so forth, I was trying to earn my clients an average of 12%. But let's just come down to reality here and say that you're earning 10%, because I have actually helped many of my clients earn 10.07% average net cash on cash. If you understand rule of 72, that means that you take 10%, divide that into the number 72, your money will double every 7.2 years. Well, let's come down to 9.6, because I can actually show you where I have averaged 9.62% for over 40 years using max funded indexed universal life insurance contracts, and I'm talking about net cash on cash. So that means you take 9.6 divided into 72 and your money will double every 7.5 years. So a good fee-based financial advisor earning 9.6, your $500,000 will double to $1 million in 7.5 years. $1 million doubles to $2 million in another 7.5 years. That's at the end of 15 years. In another 7.5 years, this is 22.5 years down the road, the $2 million doubles to $4 million. And then the last 7.5 years of a 30-year period, it doubles to $8 million. And people say, is this realistic? Absolutely. I have done this for many, many people who started out with 500 grand without adding a dime. 500,000 doubled to $1 million, $1 million doubled to $2 million, $2 million doubled to $4 million, and $4 million doubled to $8 million over a 30-year period. So let's say you've got a fee-based financial advisor that does that for you. If you do the math and you deduct 1% of that balance as it goes to $1 million, $2 million, $4 million, $8 million, you will have paid in fees over the 30-year period just under $1 million. And they say that is an inexpensive approach. You shouldn't do a commission-based approach. Well, let me show you the difference. My favorite vehicle that I help many, many people accumulate their money totally tax-free at average returns of 9.6% and even higher. But 9.6% is sort of the average for the last 40 years, is what I call the laser fund. And it's totally tax-free. But see, because I opted to be compensated with a commission based upon the new money that went in. See, I never made a dime on my clients' balances as they grew. I only got compensated in like a percentage or a commission based upon the $500,000 they put in at the beginning. When that $500,000 doubles to $1 million, to $2 million, to $4 million, to $8 million, I didn't get one dime off of that growth. Now, on $500,000, I may earn 5%, maybe 6%. Let's say 6%, that's $30,000. So I earned $30,000 one time on the front end. And sometimes that was spread out over 5 years if it took 5 years to put in the $500,000, maybe $100,000 a year. But that was it. Would you rather pay $30,000 one time or string it out and pay nearly $1 million with a fee-based advisor? Let me put it this way. If I were a realtor and you came to me and wanted a $500,000 house, so I find a house for you and I say, okay, now I have two options for you. I found you this house and I'm going to sell you this house and I'm a realtor, and you can either pay me 6% because most realtors charge 6%. So you can either pay 6% once, that's $30,000, and the house is yours, or here's another choice. You can pay me 1% of whatever this house is worth every year for the next 30 years as it goes up in value. What would you choose? Hello? Why would you pay 1%? Well, the first year, it's only $5,000, but you keep paying 1% of what that house appreciates by for 30 years, you will end up shelling out nearly $1 million. So is really a fee-based advisor cheaper in the long run? No. But see, I get compensated with money that would otherwise go out the window in unnecessary tax. And that's what you'll learn in my most recent best-selling book. Here's how you can claim your free copy of the Laser Fund. I call it the Laser Fund because LASER is an acronym that I've used for years that stands for Liquid Asset Safely Earning Returns. This book is 300 pages, and it teaches you how to diversify and create the foundation for a tax-free retirement, how you can have your money accumulating tax-free. You can access it tax-free. When you die, it blossoms and transfers tax-free. But usually the advisors who use this get compensated one time on the front end, and the rest of the time it grows. That is all purely your money without ongoing fees. This is the most inexpensive financial vehicle in the long haul, and you will see examples in this book of how inexpensive the fees are as time goes. Even if you subtract the cost of the insurance that the IRS says has to be there in order for it to be tax-free. To claim your free copy, go to laserfund.com or click on the link below. That's laserfund.com. Contribute a nominal amount towards the shipping and handling. I'll cover the rest of that. I'll fire out a copy of this 300-page book for you. There's also options there to listen and learn and watch and learn, but here's to your brighter future.